All right, we're at the top of the hour, so we can go ahead and get started with our next presentation. Thanks, everyone. All right, so up next, we have Elizabeth Madlam. She's a Deputy General Counsel and VP of Compliance Operations at Compliance Alliance, and she'll be covering safety and soundness, COVID-19, PPP, and CRE. All right, Elizabeth, I'll turn it over to you.
Great, thank you so much. Yes, and again, my name is Elizabeth Madlam. I am happy to be joining the Western Bankers Association's Risk and Safety and Soundness workshop. We're going to be covering safety and soundness in light of COVID-19, PPP, CRE. And so I really hope to be providing you with kind of an overview of just basically the current state of the financial services industry, the impact of COVID-19, what it's had on it. And in this presentation, we're going to break down some of those repercussions. We'll talk about the OCC semi-annual risk perspective report, the interagency safety and soundness guidance as it relates to regulatory expectations and examination trends. And then we'll move forward and begin to break down some of the risks that are associated with loan modifications, lending during a pandemic, as well as the ramifications to safety and soundness because of your participation in the Paycheck Protection Program or engaging in commercial lending. So it's not a surprise that the coronavirus has caused a crisis for the world's economy, the markets, but it's much more than just asset liquidity, recessions, bear markets. It hits everyone and no one's been immune to it. And it's not a weak economy that causes, unemployment concerns, particularly coming out of a pandemic. COVID really forced the closure of restaurants and hospitality industries, service industries, and other professions that require that close personal contact. And as a result of COVID-19, it's no surprise that it put the financial markets under greater stress. We know the Federal Reserve over the last year has taken a number of significant measures in order to provide monetary stimulus, cutting of fund rates, expanding reverse repo operations. It seems like daily there was a new initiative coming out. But of course, and you can't leave out the Paycheck Protection Program as a result of the CARES Act. We'll talk about that more, but access to funds, lending in a, living in and post potential COVID world is not going to be without ramifications. And because of that, your organizations are just naturally flooded with risk right now, more so than necessary, or more so than what you've experienced. And so lending during a pandemic fueled environment, particularly an economic environment, is really going to pose its own unique risks and considerations for financial institutions. Not only do financial institutions need to have that demonstrated pandemic preparedness plan that's in place, it's activated, it's working, you also now have to show resiliency to market volatility, technological threats, regulatory compliance, operational challenges, and particularly when we talk about operational challenges, that dramatic shift of working to a remote environment. So COVID-19 really has just created unprecedented business and regulatory disruptions in a really condensed period of time. And it's forced a lot of massive changes about how financial institutions actually operate. What regulators, what supervisors are going to be expecting. And then just not to mention the overall impact that COVID-19 has had on society, on businesses, on individuals. And so banks right now really need to be focusing and emphasizing a dynamic process for identifying these emerging and intensifying risks. So COVID-19 has definitely caused, that significant financial stress, that economic vulnerability, and it can increase as a result non-compliant behavior by financial institutions. So it's impacted your liquidity risk, your management and response styles. It's forced you to review your credit risk systems. It's emphasized a need for capital and stress testing of your models that was never really anticipated because of just lack of a kind of global event that we've experienced. So institutions have really just been challenged with their ability to manage, to report on their liquidity positions, as well as funding capabilities. And we know the FRB definitely is in the forefront of taking those steps to try and stabilize the markets. But even though they've been doing that and making funds available, banks are still facing challenges when it comes specifically related to liquidity risk management. There's liquidity stress management reporting requirements, there's liquidity preservation and contingency funding concerns. And then you have liquidity tests, stress testing assumptions. And so monitoring is really important when it comes to liquidity management oversight and protocols. And you really want to make sure that you have processes in place that are implementing efficient responses to regulatory inquiries and changes in reporting requirements, strictly when it comes from a capital and liquidity standpoint. But on top of just monetary, COVID-19 has also impacted your controls environments. And banks cannot be overlooking your ability to be able to identify, to mitigate, and to respond to risks, particularly fraud. A key player here are your fraud risk assessments. Financial institutions really should be revisiting risk assessments in general, but including your fraud risk assessments, fraud risk for your institutions based upon your location, your product services offerings, your customer base, as well as just potential COVID-19 impacts. I know everyone's been dealing with cybersecurity concerns. We had that SolarWinds not too long ago. Latest update now is Microsoft is having cybersecurity concerns. And so being able to be monitoring monitoring particularly for any kind of emerging risks that are resulting from changes in control environments, incorporating that into your fraud risk assessments is really going to be crucial to stay ahead of the curve. And it really becomes critical for all lines of defense. That includes your internal auditor. All need to be working together, actively engaged in this ongoing evaluation of risk, as it includes fraud risk, as well as your assessment of your appropriateness of controls and your current environment within your institutions. So you want to be asking yourselves whether or not you have sufficient resources to be able to, of course, identify, assess, and test fraud risk factors, fraud schemes that result from all of these shifts in your control environments. And when you're determining the need for this type of modification of controls or new controls, you want to really be assessing the type of risk of fraud that's associated with modifications. You want to be identifying fraud risks that are associated with automated controls that are really susceptible to fraud, either because of COVID-19 or just based on a historical trend like fintech payments. You want to make sure that you're considering alternatives for fraud controls that require actual physical observation. And you want to be identifying fraud risks as they relate to remote monitoring controls, your employees working from home. And what kind of goes hand in hand with this fraud risk is really change management. You don't want to forget about change management. You don't want to forget about your change management program. Changes to federal protection laws, federal regulatory expectations, particularly of the consumer kind, they've occurred at a rapid pace, particularly since the last financial crisis. So they've ranged from minor technical changes to major and substantive ones. I mean, TRID is an example of that. So you really want to make sure that on top of having an understanding and your finger on the pulse of what's happening in the regulatory environment, that also tailors when you're looking at a change management program to your new products, your new service offerings, which could be subject to regulatory requirements that you might not have considered before. So just depending on the nature of changes, financial institutions really want to ensure that your change management program is effectively gathering all of this information, whether that's through a third-party service like Compliance Alliance or some other vendor, or you have someone on staff that is just combing through the regulatory updates and keeping the departments that are related to this abreast of any kind of changes. However the case may be, it's commensurate upon your institutions, as well as the types of product and service offerings that you have. And when you have an effective change management process, that's going to really assist you with detecting new or amended rules or regulations. It'll help you evaluate those rules and then understand how those requirements are going to be affecting your bank's processes and making modifications to those processes. So when you're creating a change management process, that's really what's going to help your institutions identify and then appropriately respond to changes in particularly consumer protection laws and regulations, but to also help you effectively implement changes to your products and services. The biggest thing, it's the last bullet point here on this slide that I do want to call out as another factor of risk, has been surrounding business continuity, your workforces being impacted strictly because of COVID-19 limitations. I know currently some states are in the phase of completely opening everything up. Others, I'm actually located in Seattle, Washington, so we're a little bit more conservative with our stance on what protocols will be or the new norm will be of reopening the economy up here. But overall, the past year, everyone's really experienced this mass migration to working remote. And perhaps for your organizations, it's a transition to a new norm schedule or limited office hours, or you're working from home combos. And so this work from home really has brought about some issues as it relates to oversight of conduct, how to be tackling remote supervision, surveillance of employees, as well as just general operational challenges that can't go unaddressed. So massive impacts from COVID-19. These are just a list, the last two slides, of some of those examples that have immediately impacted the financial services industry. So how does this all relate to what regulators are expecting? Again, you're going to be hit with risk and compliance trends in this presentation. So don't let the long list dissuade you, but there's a lot of topics that regulators are looking for, and they're looking to determine whether your financial institutions are actually having demonstrated disaster or pandemic preparedness plans in place, that those plans have been activated, they are working, any gaps you've mitigated. So you really need to be addressing, you're kind of the jack of all trades now at this point. You have to be addressing resiliency to market volatility, technological concerns, customer investor protections, regulatory compliance, operations, and that includes your products, your services, third parties, employees. That sounds easy, right? So this is really where organizations need to be addressing, again, your business continuity plans, realizing whether or not you were even prepared or were prepared at the onset of the pandemic. And it's okay if you were not, because now is the time, a year out, to be proactive, to begin this process of taking into consideration all of the facets that needed to go into the challenges and your responses to these challenges. So that includes your contingency planning, your technological readiness, employee policies and procedures, remote working, enterprise risk management. The list goes on, but regulators' main goal really is they're going to be assessing you in order to determine what you have done has been everything within your power to minimize these adverse effects to customers, to investors, and that's through your forbearances, your disclosures, your participation in CRE or with the Paycheck Protection Program. So how are we supposed to get all of this accomplished? How does safety and soundness come into play with this? And with this emphasis on risk, COVID-19, the first thing you need to remember is that COVID has brought an increased emphasis to your bank's BSA AML programs, just as a result of the increased financial crimes that are COVID-19 related, as well as this new environment that customers are living in when it comes to accessing and transacting through your institutions. A lot of the times the shift has completely been to an online platform. So online, mobile banking, all of that has increased for financial institutions as a result of COVID-19. And that could have been perhaps prematurely when it came to respective of your BSA AML programs. You might not have had parameters in place for adequate capturing of volume and levels and appropriate risk ratings to that. So you really need to be considering, before we move forward, the risks to your BSA AML programs. What are the levels of activity currently? Are they within your bank's risk thresholds? Are there types of accounts that are being opened or types of customers that the bank is receiving? Are they all within your monitoring and assessing of their activity or the type of customer that you even want to be banking? And so there have been issues, we know, this past year with BSA, AML, SARS, and CTR filings, timely considerations of those have been impacted. So how are you trying to address these gaps within your BSA AML programs? What kind of changes to monitoring and reporting of suspicious activity, especially in a work from home environment, have taken place within your institutions? And have you actually updated your policies and procedures to reflect whatever new approach your operations had, whether that was a combined work from home office or completely remote? So you want to be able to show regulators what your expectations were during these periods of intense COVID-19 lockdowns, and how you've adjusted your policies and procedures since. So it's really important, again, that you're staying abreast and in front of all of these risks, particularly surrounding fraud. And that, are you educating relevant personnel, front lines of staff, call centers, back office, quality control, of any of the kind of newest trends of fraud? I think they just released this week even more EIP guidance of fraud that's happening, particularly for COVID stimulus payments. So who within your institution is responsible for monitoring this, and how is it being disseminated? There's one good thing that we've learned from Facebook, and that's that information is at its most impactful when it's quickly and seamlessly disseminated and made available. So how's that taking place within your institutions? There's been a lot of challenges when it comes to your bank systems of model risk. So business models are being used that previously did not incorporate or even consider COVID-19 pandemic implications or ramifications. So has your bank taken the time to reassess your risk models in light of the impacts of COVID-19? And regulators are wanting and expecting to see a shift in focus here in order to account for what was once unknown that has now become our new normal. So you want to be considering the methods of lowering and reducing enterprise risk, whether that be mapping, data governance, benchmarking, contingency planning. What are your institutions doing from a procedural standpoint, one that's repeatable when it comes to examining and mitigating your enterprise risk? And you want to make sure that you're implementing models and model testing within your compliance programs to be able to assess the stress test outcomes, credit losses, things of that nature. And again, one good example is the PPP program, and its accounting considerations. What have been the pros and cons for your institution as a result of participating in the Paycheck Protection Program? And while it goes unsaid that you've had a large impact within your communities and supporting and lending to small businesses during this time, at the end of the day, the risk of the PPP is solely in the bank's hands. Forgiveness that was once viewed as guaranteed is slowly being stripped away. SBA audits are now for all loans, regardless of asset size. Clawbacks of fees are a potential. And then in the end, you're stuck holding a 1% unsecured loan on the bank's books. So like we talked earlier, there just really is this resurgence of importance when it comes to monitoring, testing, and having a clear understanding to be able to present to regulators how your participation impacted your institutions and what you did to mitigate. So we'll get into briefly the interagency guidance. There were two key ones to call out. The first being from the end of last year. This was when the OCC released their semi-annual risk perspective report. Its purpose was really to address key issues that banks are facing and focusing on what those threats pose when it comes to safety and soundness of banks and their compliance with any kind of applicable laws and regulations. And so from this, there were four main areas that included operating environments, bank performance, trends in key risks, and supervisory actions. And the OCC noted that compliance risk is elevated due to a combination of operations, employees working remotely, and just the requirements to operationalize new federal, state, and proprietary programs like the PPP that are designed to support the customer base, the nation, and other relief efforts. So it was important that banks be reviewing this report because it includes information about counteracting operational risk, developing current technological systems that are in response to increased cyber risks. And overall, going into COVID-19, banks already did have a fairly adequate cybersecurity system. But there are concerns remaining when it comes to a bank's IT systems, change management, information security, just in general. So as a result of this increased ransomware attacks at banks or against banks, sound risk management principles when it comes to cybersecurity are going to be key, as well as auditing of your customer base, their user access management processes. You want to make sure that you're doing that to develop and ensure the use of strong authentication controls. So volume of change, short timelines for implementing changes, just from a regulatory standpoint, but as well as operationally, have really put additional strains on banks. making you operate in a stressed environment. And the OCC has put it out there that they are aware of this. There's a real emphasis in this report on financial institutions making appropriate adjustments. And these appropriate adjustments are supposed to be risk-based adjustments. And that is within not only your BSA systems, your other compliance programs, but just industry-wide, enterprise-wide, what are your risk-based adjustments, just given the nature of lending or banking during a pandemic. And when it comes to your bank's risk management programs, there was a renewed emphasis by the OCC regarding your third-party due diligence, your monitoring, your oversight processes, operational errors. Again, a focus on heightened cybersecurity risks, and then potential fraud just as it relates from the stimulus program. But to sum up, basically, the OCC is telling us specifically that you need to be maintaining controls for third-party due diligence and monitoring and basically otherwise, oversight processes. You need to be aware of your operational errors. You need to look at heightened cybersecurity risks, and you need to be looking at potential fraud related to stimulus programs. This was all the breakdown from the OCC. And they're doing us a favor by recognizing the fact that risk has been heightened, but at the same time, they don't really give the best guidance on all of the steps for mitigation, but we're going to talk about that in just a moment. To round it out, they did discuss bank profitability. They noted that it had been challenged as interest rates are at their historic lows. There's past due loans that are happening. There's provisions for loan losses that are increasing. There's operational expenses that are rising. And it's important to note here, and we'll go into more detail when we talk about loan modifications, but forbearance programs are really camouflaging weaknesses and weakening bank asset quality. And when is that going to bust? We're not quite sure. But the ultimate increase in non-performing loans and credit losses from a pandemic and its subsequent recession is really going to be difficult to determine for financial institutions just due to your forbearance programs, as well as measures that have been taken by lawmakers and bank regulators in order to support credit availability during a pandemic. We do have, of course, reporting standards for the bank that have been laxed under the CARES Acts. TDRs, we'll talk about that when it comes to loan modifications. But it doesn't change the fact that your operational risk will oftentimes, it's sometimes the most visually easiest to detect and see. It's definitely elevated. It's often misassessed by banks when you're implementing new processes, new procedures, adopting a pandemic-related continuity plan. So the agencies really called out the financial risk here and also basic just red flags. They really wanted to focus an emphasis on interest rate, operational risk as it related to COVID-19, of course, that cyber risk and your compliance, and then consumer compliance and fair lending. Fair lending is going to be a huge push when it comes to examinations this year. There's a lot of different avenues that they're going to be examining under a fair lending exam. And all of that ties into your safety and soundness. And luckily, we did get a COVID-19 interagency safety and soundness guidance. This slide really just talks all about the examinations and the expectations as a result of COVID-19 impacts. And they let us know what the regulators are going to be doing, how they're going to be observing us. And so in this guidance, they stated 3 or 4 main points. Basically, I combined them here on this slide. But what they're first going to be considering is just acknowledging of the fact that we have a unique and evolving and potentially long-term set of issues that banks are going to be facing because of COVID-19. And so they're going to be flexible in their supervisory oversight. They are going to continue to be assigning CAMELS and ROCA supervisory ratings. They're going to be considering whether management has managed risk appropriately and has taken reasonable actions to respond to COVID-19 impacts. And they're going to be looking at and including considerations when it comes to assigning those composite and component CAMELS and ROCAs ratings. So what are they going to be expecting? They're really wanting to be looking at recognizing and bank management, particularly board, recognition of the stresses that have been caused by COVID-19 on your financial condition, on your operational capabilities. And they want proof. They want documented proof in some capacity that you have exercised and taken reasonable efforts and actions in order to respond to COVID-19. So how are you going to be able to show that? Through your policies, through your procedures, through amendments, or memos when it comes to loan programs or something of the like. We want to make sure that you have a way to show regulators and examiners how your actions were appropriate. And when we're considering safety and soundness at an institution, examiners are going to be assessing the reasonableness. So it's great that you took action. It's great, even better that you have it documented, but how reasonable was it when it comes to a pandemic response? And all of this has to be encompassing your institution's business strategy, your operational capabilities, your capacity during a pandemic environment, because examiners are going to be focusing on and considering your institution's size, your complexity, the risk profile when they're reviewing management's risk assessments. They're going to be looking to see whether or not management really was effectively and is effectively responding to any of the changes in the institution's business markets, and whether the institution's longer business strategies have evolved to the changing environment, to the changing times. Examiners are wanting to assign, of course, those composite and component ratings, and all of that is going to be based on their assessment of these facts. So an examiner assessment may result in downgrading components or composite ratings for some institutions just because of those variables. And when they're lowering a rating, they've made it clear in this guidance that examiners are going to differentiate between weaknesses that have been caused by external economic related problems compared to a weakness in risk management and governance issues. So examiners are going to be considering what your efforts were to work prudently with borrowers that have been affected by the pandemic. And in the enforcement action process, the regulators are really going to be considering whether bank management did actually appropriately take planned steps for financial resiliency, operational continuity. Have you implemented prudent policies? And are you pursuing really just realistic resolutions to your institution's problems? The regulators are going to tailor their formal or informal supervisory action to your institution's specific issues, as well as your willingness and your ability to resolve those issues. But there still is a greater scope to this picture that they're looking at. It's not just we were hit with hard economic times. It's how did you proactively respond to that across your enterprise? Now, back in April of 2020, the agencies did issue a revised interagency statement. That was where they were really encouraging financial institutions to be working constructively with their borrowers that have been affected by COVID-19. They provided some additional guidance when it came to those loan modifications. And what this revised statement did was it provided the agency's views on what consumer protection considerations should be. And so what this did, and we'll move into now the discussion of loan modifications, is that what they did is they clarified this interaction of practices that were between interagency statements that were issued back in March of last year with CARES Act Section 4013. And Section 4013, what it did was it allowed financial institutions to suspend the requirements to classify certain loan modifications as TDRs, or troubled debt restructuring. So the revised statement provided this supervisory interpretation about past due, non-accrual reporting, requirements of loan modifications, as well as regulatory capital. And it kind of created a catch-22 for financial institutions. So while the agencies have openly encouraged financial institutions to work with borrowers, and they've stated that they will not criticize institutions who have done so, that's when the other shoe kind of drops. All of this has to have been done within a safety and sound manner. And so prudent loan modification programs are their buzzword. Those are what they're looking for to have been offered by financial institutions to customers that were affected by COVID-19. And all of that has to have been done in such a way to mitigate adverse impacts to the bank, to the borrower, and to lead to eventually improved loan performance and reduced credit risk. So here's where the agencies are going to be exercising their judgment on reviewing loan modifications, including TDRs. So while they're not automatically adversely risk rating credits that have been affected by COVID-19, and it includes those TDRs, this becomes yet again an opinion-driven approach by the agencies because it's not clearly defined for financial institutions. And because of that, financial institutions are going to want to be monitoring and managing their credit risk in a prudent manner. And again, I put that in air quotes because we don't have a clear definition. But that is the method and that is the standard that has been set by the interagencies. But all of this has to be done in accordance with applicable laws and safety and soundness principles. So even if a loan accommodation is granted and not considered a troubled debt restructuring, the allowance for loan and lease losses is still going to need to document the bank's evaluation of these accommodations and the associated risks. So for many financial institutions, a large number of modified loans have already returned to a normal payment practice or are performing under the modified terms. But there are also many that are not. And so communication with your borrowers right now is critical. And credit risk management really needs to be found within your management's periodic evaluation of your AID-LLLs. And so accommodations can continue to pose inherent risk to your bank loan portfolio, even if it's not designated as a TDR. And that's important to emphasize. So I'll say that again, is that when you have accommodations, they can still continue to pose inherent risks to your bank's loan portfolio, even if they have not been designated as a TDR. If loans are going to be subject to risk ratings, the bank is going to need to be updating your risk ratings to reflect the revised financial status of that borrower. So you could consider pooling loans currently under the accommodation, either in total or by loan segment, and then applying all ALLL factors that are based on historic loss rates, your own bank's experience with similar accommodations, or just any other known qualitative external factors. But remember, like we mentioned earlier, how useful are your models when they fail to adequately capture an event like a global pandemic? Are these models reliable? And that brings us back to that discussion we had a couple slides back about whether or not you need to adjust your models and your risk stance from your model interpretations. Another factor is that those loans currently under accommodation can remain in just part of a homogeneous pool with general qualitative and environmental factors being assessed on them as part of a pandemic-specific qualitative factor. And back in 2006, the interagencies did give a policy statement on allowance for loan and lease losses that do list qualitative and environmental factors or external factors, which could provide assistance. But even if you walked into COVID-19 with a record low level of charge-off loans, many institutions did, you do want to keep in mind that loan modifications can and are masking risks that are not yet uncovered in conversations with borrowers. So this is where documentation is going to be key in relation to your institution's qualitative and environmental factors in order to assess truly what are the effects of COVID-19, what is the possibility of unaccounted increases in charge-offs that are related just to the current economic environment, and how do you stay abreast of this? You want to make sure that you're reviewing your particular region's unemployment rates. You're looking at real estate values, both residential and commercial. You're looking at local government mandates like capacity limits or executive orders halting repossessions or foreclosures. And you want to be staying just on top of the ongoing shutdowns of certain businesses or reductions in capacity. And I have hyperlinked here on this slide here, just some of those topics that we discussed as far as guidance for your further review. But I do want to call out, of course, before we move on with just basic compliance concerns and the PPP, that the CFPB actually back in July of this year, they hosted a webinar for the first time that was about supervisory and enforcement priorities in light of COVID-19. It was unrecorded, but the CFPB announced that they deprioritized a good portion of their agency's existing exam schedule in order to what is now known as a prioritized assessment, to conduct a prioritized assessment that focus on some key initiatives. And they're focusing on consumers having trouble making loan payments, markets where Congress provided those special borrower protections under the CARES Act. And this is going to include residential mortgage servicing, student loan servicing, auto loan servicing, consumer reporting considerations, and collections. And so in this, the CFPB stated in the webinar that they plan to be assessing financial institutions' implementation of the Paycheck Protection Program for fair lending compliance. And we expect that these prioritized assessments are really going to be the leading edge of CFPB's supervisory and enforcement work when it comes to consumer financial service markets that have been most impacted by the pandemic. But they announced this shifting focus of their examination program of again, capturing prioritized assessments. And prioritized assessments, according to them, are going to be narrower than a standard exam in time frame, as well as in scope. And so these assessments are going to focus on markets in which consumers are having trouble making those loan payments, products and services that have been offered for either federally mandated special borrower protections, or just products and services that you as an institution decided to implement. And so they are using both consumer complaints and news reports to really identify institutions to bring about this prioritized assessments. And segue into our topic here of the Paycheck Protection Program, but these prioritized assessments are going to examine your originations under the Paycheck Protection Program. The PPP, this just continues to be an uphill battle. It's something that's going to be around for a long time, inconveniencing banks, I feel, half the time, and causing a lot of frustration for borrowers at the same time. But as we know, the SBA has been forced to release their loan data when it came to the PPP. It's important to note that this release of information does provide names, accounts, addresses, industry codes, lender information. So why is it important for banks, and what should banks be doing to prepare just for any questions regarding its involvement or current borrowers? And what this release of information did is it provided unexpected risks for PPP borrowers and the bank alike. Some third-party businesses are using this publicly released data to solicit business from these PPP borrowers, specifically referencing the name of the actual lending institution. In many cases, not even disclosing that they were unaffiliated with the PPP lender. Others are implying that there's some kind of business relationship where none exists. And as we know in the news, it keeps coming forth, crazy stories of PPP borrowers using funds to buy Lamborghinis or Chanel bags. But there has already been several hundred PPP fraud investigations open. I think that number is higher now, but originally it was 50 individuals that have been charged with taking more than 175 million in fraudulent loans. And so really, to combat these claims, it's very important to make sure that you have procedures in place that are assisting your staff with addressing these concerns with borrowers. Do you have any press releases prepared on your stance? Do you have fraud reviews that are taking place and being performed on your data to respond to local and national news outlets, or just for your own risk assessments because of participation in the PPP program? And how are you really going to be protecting, to the best extent possible, personal information and that customer's relationship with your bank when a lot of that has already been made public? So participating in the Paycheck Protection Program has not been without risks. I've been talking a lot about the Paycheck Protection Program, and I've been one to not let this go. That it wasn't as easy breezy of a loan in name as it's been made and sold to banks from the beginning. So there's risks surrounding just the emergency nature of the program that required everyone from the get-go to scramble to prepare to meet the rush of demands for forgivable small business loans. This has continued throughout the entire existence of the PPP. It's kind of a hurry up and wait for banks. Compliance Alliance has really been advising banks to examine their policies, their procedures, to update as necessary to ensure that you are consistent with your loan decisioning processes, You're providing equal treatment to all borrowers and applicants. And you're really going to need to be preparing to examine and defend your decisions when it comes to processing times, cherry picking of loans or the appearance of cherry picking of loans rather than going through a first in, first out underwriting style. So now it's not only just public, but also regulatory agencies who are really shifting their eyes to lenders to ensure this maintenance of compliance when it comes to PPP. Um, you know, with that announcement in the webinar that the CFPB is planning to review PPP loans for fair lending, as far as equal access under ECOA, don't think it's just CFPB related. Numerous other regulators, OCC, FRB, FDIC, all have taken a stance to review from a fair lending standpoint the Paycheck Protection Program. But where that correlates to safety and soundness is that they're going to be looking at your actual credit underwriting or compliance with the underwriting provisions of the SBA's program and how you went through your process of application gathering through forgiveness. And so we know what at least the CFPB is going to be looking for. I can imagine very similar for other financial institutions, but they want to be seeing what steps. And these are documented steps that you had when you took in these PPP loan applications to really ensure that you were following compliance with fair lending laws, as well as ECOA Reg B and your safety and soundness by taking these loans on while you're implementing and partaking in the Paycheck Protection Program. They're going to be looking at, what restrictions apart from the SBA or Treasury did the bank potentially additionally put on PPP loans? So what procedures or policies did the bank put in place that could have exceeded the SBA's requirements for the program? And then what steps did the bank take to ensure that it complied with Reg B's adverse action notice requirements? That's one of the biggest ones. It continues to cause a lot of frustration for banks and is an area certainly of the most lack of compliance when it comes to the Paycheck Protection Program. But overall, CFPB aside, regulators as a whole are really going to be examining and trying to find signs that lenders did not follow procedures, whether that was SBA, Treasury, or internal, especially as it relates to vetting borrowers' payroll expense calculations, assisting ineligible borrowers to get a loan knowingly, showing favoritism or discrimination against borrowers or groups of borrowers, or just generally having inconsistent lending practices or policies. So this good faith rule that was brought about by the SBA isn't going to shield lenders if borrowers broke rules or perjured themselves on their applications to an extent that banks are not going to be completely protected. You have the potential to be held accountable if you failed to comply with the PPP's underwriting requirements and reviewing of knowing who your borrower was. So this first come, first serve, equal access standards, other regulatory requirements, all of that are coming into play. And particularly now, they are looking at race-based lending discrimination. So how has your institution conducted a PPP audit? Have you conducted a PPP audit? You really want to make sure that you're prioritizing internal and independent audit programs on the PPP, that you're reviewing, you're confirming the existence of internal policies and procedures to show that underwriting and whatever other practices or policies mandated or not internal were actually being adhered to. And if not, what was the bank's exception for that policy? What were your tracking mechanisms for that policy? You want to make sure that these audits are looking at whether data analysis was performed by the bank in order to ensure, similarity of treatment among borrowers, and whether the bank has actively taken steps to address deficiencies that may have been found within your program guidelines or with regulatory compliance requirements. And this is just the bare minimum. You want to make sure that you're actively, one and done isn't enough here, that you're actively double checking, you're actively addressing deficiencies within the program continuously, not just from the beginning or not just at forgiveness application time when they begin to roll in. And as we know, this has been a changing program daily. I feel like for a while there, it was almost every other day we had some new update from the SBA and the Treasury on program requirements, on calculations, max loan amounts, forgiveness protocols. So because of that, you get the pleasure of making sure that you're continuing to look at your auditing and your data analysis procedures throughout your entire participation of this program. And speaking about this issue of forgiveness, we have now multiple application forms for borrowers that have to be selecting which one they're going to be submitting for their loan forgiveness application. And I know everyone is eager to get these loans off their books. Borrowers want to get forgiven, but gently nudging or shoving applicants to apply for forgiveness might not be the best thing right now. It might not be what's best for the business. It might not be what's best for the bank. There's talk of just continued changes when it comes to the program. And so you want to make sure that you're not telling borrowers, forcing them to apply or hold off on applying. You want to be informing them just of what their options are. And given the nature of this program, you think you know it, and then something flips on a dime the next day. So definitely a lot of data analysis and risk and audit come into play because of your participation in the Paycheck Protection Program. Commercial real estate, before we round out the end of our hour, commercial real estate really just has proven to be an area of concern when it comes to the overall safety and soundness of a bank. CRE really discusses a wide range of properties, right? So you can think office buildings, hotels, retail storefronts, restaurants, hospitals, stadiums, schools, even apartments, all can get lumped into this topic of commercial real estate. And CRE financing markets really, they're large. I think the end of last year, it was over 3 trillion. So in a sense, CRA is very similar to CRE, not CRA, sorry. CRE is very similar to consumers buying a house in some ways. Borrowers are taking out a mortgage from a lender to purchase a property. The property acts as collateral for the loan. Lenders can either keep that mortgage on their books or they can sell it to another financial institution who then packages those into a commercial mortgage-backed security. But despite those basic similarities, really the structure of CRE loans, including the terms, the rates, are different from residential mortgages. And these differences are what make CRE markets unique, varied, and complex. And so there's so many different sectors that participate in the CRE markets. We know federal financial regulators do indirectly address CRE by setting policy for bank lending to CRE markets. The Federal Reserve can influence the market liquidity concerns by purchasing assets like CMBs from investors. But COVID has really created, again, another unique environment specific for CREs. And you can drive down any street in any town of America and see shuttered businesses or those operating at a limited basis. And so CRE tenants are struggling to make their payments. There's limited travel that has impacted the tourist industry. Office spaces are pretty much vacant as more businesses shift to work from home models. I live in downtown Seattle, and there was a mass exodus once Google and Amazon and other tech companies that once dominated downtown were allowing for a remote living. Office buildings completely emptied, and all of the apartments were flushed because people didn't need to live in the downtown city to get to work. So it's interesting just that perspective to have personally, but stadiums, arenas, sports teams, those are ceasing operations. And even hospitals, elective surgeries at hospitals are being put on hold. And so you can see how CRE is just rampantly impacted because of COVID-19. And those are just a few examples. But really, the impacts from COVID-19 just have substantially changed CRE in general. And the way that lenders are structuring deals and offering credit to commercial borrowers, all of that's been altered to address more of the risks, or it should be altered to address more of the risks. And those are risks that are known and still being uncovered. And all of that, it comes with just, changing social preferences. And so lenders are making CRE loans. They've really found that they can become too large, too risky to hold in portfolio. And of course, there are ways that financial institutions can distribute the risk of these types of loans to other investors, loan syndications, loan participations, but even that can pose risks too for your institution. So one question in general with CRE and what it actually poses is a systemic risk. And systemic risk is a type of risk that some development will cause this widespread financial instability. We saw this back in the 2007 to 2009 recession. That's just an example of showing how this interconnected relationship between financial institutions and industries is going to be contingent upon financing remaining liquid. Many businesses depend on financing to remain liquid, to pay their creditors. And as we've seen balance sheets deteriorating just because of economic activity, there's outstanding loans that can't be repaid. They're beginning to enter delinquency. And so this systemic impact on financial institutions is going to depend on several factors. That includes leveraging, liquidity profiles of the markets. But things are really beginning to mirror how in 2007 we had a class of assets and showing us that how we can pose systemic risk because of the commercial mortgage markets and then the commercial mortgage-backed securities. They're becoming smaller, less leveraged, more liquid. So definitely commercial real estate is something to be cognizant of, to go through your strategic platforms, your strategic planning, and determine what the risks are relative to your lending areas, because every location in the US is experiencing different kinds of strains overall when it comes to CRE. So key steps to managing risk. This slide is all about risk assessments, their new emphasis in examinations. Examiners are really going to be wanting to validate the quality of your risk assessments. They're going to want proof that your risk assessments are staying current with evolving risks. Examiners are going to want to be evaluating management's internal and ongoing risk assessments of your bank's risks. So are your risk assessments actually accurately and actually capturing the risks that have been redefined because of COVID-19? So regulators are going to want to be evaluating your institution's risk identification, your risk identification process, your reporting process, and all of that's based on the level of information that's available and the stage of local economic recovery surrounding your institutions. But I don't want to leave you with these last few moments with all gloom and doom or heart palpitations. You need solutions and you need resolutions. So what can banks do? And here we kind of have some key steps for managing those risks. We just talked about it, but frequent dynamic risk assessments, those are going to help banks understand these changing and shifting risks. You're going to want a compliance team or an enterprise risk or some makeup of that is pivoting. And they're pivoting so that they can consider these risks and these challenges that are created because we have a rapid and radical changing environment. Compliance, ERM, audit, or all three must be performing frequent and dynamic, meaning non-formalistic risk assessments. And those are in order to really quickly be able to understand the new circumstances and address the risks in a holistic way. Breakdown of what this process really is. It's deliberate assessment of risks that are based on changes in the environment. So for example, business, technological, or regulatory. And then what are the ways that you are managing those changing risks through expedited action? So are you seeking relief from regulators? Are you updating your policies and controls? Are you escalating issues in an appropriate fashion? You really need to be optimally deploying your resources when it comes to managing risks because of this new environment that we're living in. And electronic communications surveillance, that's kind of heightened given just this move towards digital communication channels. But are you abreast of disseminating information to your staff? If it's a work from home environment, are you having periodic checkpoints and conduct reviews to make sure that these changes are being adapted to your new normal and they're adjusting as risks may present themselves? So it's important to be working with your business teams, one, to understand changes to business strategy and risks profiles. And you want to make sure too that compliance is continuing to focus on managing those key compliance risks. Just given the expansion and the shift of working remotely to potentially coming back into office, certain plans, whether that be workflows or surveillance or upgrades to your communication systems, all of that this past year has been accelerated. And some may have been deprioritized, but do you have an understanding of where workflows come into play as risk is being assessed within your institutions? You also want to make sure that you're reviewing whether the workplace actually has appropriate tools and access needed to perform your key duties that are identified because you have these dynamic risk assessments. You want to make sure that you're maintaining this connectivity with each other. Again, change management program. How are you disseminating information to the right people within your institution, the business lines that are impacted, and breaking it down so there's an understanding of these changes or of these risks. So productivity management, that's going to be critical as an area of high risk. And this connection between compliance, legal, internal audit, ERM, to making sure that you're not getting a backlog of these risks, and you're communicating and developing and updating your policies and procedures as necessary. So it's always important to find ways to foster a sense of community, to maintain employee morale, particularly when we're talking about the lovely topic of compliance and safety and soundness. But it is crucial when it comes to the implementation of a successful risk management program and a safety and soundness perspective to your product and service offerings, and just enterprise-wide for your institutions. So I see we do have just a few minutes left. If you did have any questions, our contact information is here on this slide. If it's after the presentation or if there were any now, I'm more than happy to address. But if not, it was my pleasure to be here with you all again. Again, my name was Elizabeth Madlam. I'm with Compliance Alliance based out of Austin, Texas. But I'll turn it back over to you, Glenn.
Great. Thank you very much, Elizabeth. Looks like we don't have any questions at this time, but as Elizabeth just mentioned, please feel free to reach out to her or follow up with me and I can get you guys in contact. So thanks again for your presentation today, Elizabeth. Great job.
Great. Thank you so much.
Thank you.